Hello and welcome to Choose a Fi. Today on the show, we have our good friend Brian Feroldi, who is here to talk about the investing lessons we learned in 2022. And as we all know, 2022 was a brutal year. And Brian put together this incredible presentation on the key investing lessons that 2022 taught us. And I think it's really important for us to take a step back and really consider these. Obviously, those of us in the financial independence community, many of us are low-cost index fund investors, and that is great as a background. But as Brian has taught us, Brian specifically has taught us, individual stock investing can be an important part of our overall strategy and portfolio. But it's important to take a look at these lessons because it's more than just the nuts and bolts of finance. It's about psychology as well. And I think that is something that is ever present in the human condition. So I'm really, really excited for this episode. Welcome to Choose FI.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, Brian, welcome back to Choose FI. And of course, I should have mentioned, as I always do, you are the author of the book, Why Does the Stock Market Go Up?, which is a phenomenal book. Anybody can find it at choosefi.com/Brian. That will always take you just straight to the different buying options. And you are also prolific on Twitter and have, I think as we're recording this, so we're recording this on December 8th, 2022, which is really important to note since obviously we're going to be talking about the stock market, right? And anything could happen in the last couple of weeks here of the year. But yeah, you have 400,000 plus Twitter followers. So you have carved out quite a space for yourself in the financial world. So as always, thanks for coming on the show.
Always awesome to be here. And if anything should show how good of a market timer I am, I launched a book called Why Does the Stock Market Go Up? In 2022. And many jokes came out immediately after, like, it would have sold better if you called it Why Does the Stock Market Go Down? So there you go. There's my market timing skills, folks.
Well, hard to respond to that other than, yes, that is very interesting timing. All right, Brian. So yeah, as I said, we're recording this in December of 2022, and obviously anything can happen the last couple of weeks here, but it's been quite a year, right?
Yeah, 2022 has been an extremely trying year for a lot of people. The stock market got walloped. The bond market got walloped. The crypto market got walloped. Basically, a lot of things that worked incredibly well over the last 1, 2, and 3 years really took it on the chin this year. So 2022, I think investors learn the most important lessons during downturns, and 2022 was certainly a year that was filled with lessons.
Yeah, that it has indeed. And yeah, what worked incredibly well. And that's, it's interesting how much of this is based on timing and emotion. And we're going to talk about some of the most obvious ones, right? The Wall Street bets /Reddit and crypto and NFTs and things like this. It's funny though, because like I said, on the front side of this, it's amazing how much psychology and emotion really does tie into quote unquote investing, whether it's true investing or like NFTs or things like that, which when we did a couple episodes a while back on NFTs, I made great pains to say, this is not investing. 99.9% of this stuff is going to go to zero. But many people out there thought it was investing, which is maybe something we could also dive into. Like, what do you think, Brian, is the definition of investing?
Yeah, and I guess we should caveat this up front. A few weeks ago, you had J.L. Collins on your podcast, and it was an excellent podcast, as always. I love listening to him talk. And the great irony of investing is if you just set up your portfolio to dollar cost average into index funds and you didn't pay attention at all, that is actually a massive advantage when it comes to investing. My wife, for example, that's what she does with her 401k and stuff like that. And she has no recollection of what's happening with the markets at any time, right? She just automatically buys index funds with their paychecks every time they come out. And if that is your strategy, a lot of the things that we're going to talk about don't really apply to you. So the investing is kind of funny. It's like the less you do and the less you pay for, so long as you set it up right at the beginning, the better off you are.
Yeah, it's so counterintuitive. And this is something we've all been grappling with for certainly as long as this podcast has existed. It is so interesting in that, as J.L. Collins says, the simple path to wealth. It truly is. I mean, you probably know the stats, the percentages better than I do, but something on the order of 90+% of people who invest in low-cost index funds are going to outperform actively investing, certainly when everything is included, fees, taxes, et cetera. It's so interesting when you think about what other avenue or area of life is doing the simple path, the part where you're not exerting any kind of intelligence or knowledge is going to outperform. It's wild. Like I said, it is counterintuitive, but I mean, the numbers bear out over and over again.
Yep. So if that's what you've done, I think a lot of the lessons that we're going to talk about don't really apply to you. However, in 2022, we did a webinar together. And one of the questions we asked of the Choose FI audience was, do you buy individual stocks or invest in other things? And of course, there's always a chance that sample size was skewed because I was involved. But the data clearly showed a non-zero percentage of the Choose FI community does invest beyond just index funds, whether that's into individual stocks or crypto, or in recent years, we've seen things like farmland or artwork or like things like that come to market that they didn't have access to before. The people that listen to this podcast are financially savvy, financially involved, and are highly likely to be investing in things beyond index funds just because they're interested in money.
Yep, without question. I would say a significant portion of the audience, at least with some percentage of their portfolio, is investing outside of index funds. So yeah, this is applicable to everybody. So all right, let's get into it. So the major lessons we learned in 2022, where would you start with that?
So I would say the number one thing that I learned in 2022 is that the Federal Reserve matters a lot. The macro is something that I have personally always been aware of as an investor, but there's so much to consider when it comes to macroeconomics that I've never made any portfolio or economic or investment decisions based on the macro. So there are people out there that are really Fed watchers, and they analyze every single thing that they say and every move that they make. But 2022 was the year when what the Fed did impacted every market everywhere.
Yeah. So I would imagine the place to start would be interest rates. But let's, first, definitely confirm that if my assumption's correct. And second, how does the Federal Reserve exert their influence over the economy in the most succinct way? Because I think the vast majority of people, myself included, really don't have a good grasp on this.
Yeah, so I think most people understand that the Federal Reserve controls the most important interest rate essentially in the world, which is called the federal funds rate. And for the vast majority of the last 15 years, essentially since the financial crisis of 2008, the effective federal funds rate has been at near zero. And that has all kinds of consequences for all different types of assets. That is something that I underappreciated until 2022. One reason why that matters so much is because interest rates have essentially been set at zero, the returns that you get from going into the bond market or the cash market or CDs has also been effectively zero over that long period of time. So if you've wanted to generate any return on your portfolio above a 0%, you've been forced to look at different types of assets. One of those, a very common place for people to put their money beyond the bond market, has been into the stock market. That is one reason why valuations really expanded hugely over the last 10 years. And in 2022, they effectively reversed that and went from a zero interest rate environment to a rapid rise in interest rates back to more normalized levels. Now that have had severe impacts on the bond market, which makes sense. Bond prices and bond yields are inversely correlated. So as interest rates rise, the value of existing bonds does fall. That makes sense. However, it also impacts all other types of market, including the stock market. Well, one of the reasons is the one way that stocks are valued is at a discounted rate of their future cash flows. When interest rates are zero, the value of those future cash flows is very, very high because you're discounting them by such a small amount. As interest rates rise, the discount rate that you're valuing those future cash flows at also rises. So essentially, a cash flow from a company in year 5 or year 10 is now much lower now that interest rates have risen. To account for that, the price of the asset has to also change. So changes in interest rates has affected basically every market, including the stock market and the bond market.
Yeah, that's fascinating. So I definitely would have intuitively understood that about bonds, certainly being inversely correlated. So like you said, existing bonds, that's the key, right? So existing bonds at a tiny little interest rate were worth some type of face value. But then if the current prevailing interest rate has dramatically increased, then those otherwise existing bonds would just be worth less, right? People would be willing to pay less. So that makes sense. That's fascinating about the discount rate on future cash flows for essentially every publicly traded company, right? That's what we're arguing here is so that I would not have considered. And that goes back to how do you value a business, which we've talked about. You specifically have talked about on this podcast before. And just for people to understand this a little more, right? We're looking at, okay, the future value of those cash flows. This is like time value of money, almost similar where people can think about it if they're not acquainted with that. It's almost like an annuity on, I'm thinking even like Powerball or something silly like that, right? So, okay, this might be $1 billion Powerball, but it's paid out over 40 years. So the payment 40 years from now is not worth that amount today. You have to discount it back to the present value of that amount. And if the interest rate is higher, then it would be worth less today. There would be a higher discount rate. So obviously that's a kind of ridiculous example using the lottery, but I think people understand equal payments, but a payment, again, 30, 40 years from now, almost similar to a mortgage, right? Your payment on your mortgage 30 years from now doesn't cost you the same amount today because of that discounting. So it's a little higher level of concept, but I think it's important. But yeah, I mean, I guess that is saying that if interest rates spike dramatically, do you have to revalue every publicly traded company in essence?
Yeah, and even more so when we look at the companies that have been hit the hardest in 2022. Not all companies are valued equally, not all companies are priced equally. The companies that have been hit the hardest in 2022 are growth stocks, the companies that are growing the fastest, which were the ones that were the most rewarded in 2020 and 2022. When you think about it, the reason that investors are valuing those companies so highly in 2020 is effectively because interest rates were brought down to zero. So the value of cash flow 10 years from now, which is what a growth stock is really investors are banking on, would be essentially very, very high. As interest rates rise, the value of those future cash flows from that stock really declines significantly with small changes in interest rates. So that's one reason why many of the companies that have been the most hit hard in 2022 were very high growth stocks from 2021, because the future value of their cash flows makes up so much of their value today. So as the interest rate rises, the value of those future cash flows decrease, and hence why those stocks have been hit so hard.
Right. And I guess another area where the Fed raising interest rates significantly is housing, right? I mean, we've seen the housing market. We have not seen prices change dramatically quite yet. Obviously, nobody can forecast the future. I think it's plausible to imagine that housing prices will go down, but markets are interesting, right? So I am not prognosticating that by any means. But clearly, having mortgage rates, 30-year mortgage rates go from around 3% to around 7%, because there's only three components that I see to what a home is valued / the monthly payment, certainly, right? So it's the price of the home, it's the term of the loan, and it's the interest rate of the loan, right? So if you keep the first two constant and the interest rate dramatically increases, clearly, by any definition, the monthly payment is going to go up, right? And we've seen that significantly across the board. And it will be fascinating to see if, okay, is there some equalizing where potentially, I mean, I don't imagine that mortgage terms are going to go over 30 years, though I've kind of jokingly said that on the podcast or in my email. Oh, yeah, I wouldn't be shocked to see 40 or 50-year terms, right? Because again, there's really only the three inputs here. But the only one left then is home prices. And it's yet to be seen what will happen. But it would not shock me if home prices did reduce slightly, if not dramatically.
Yeah. House prices around me are still very, very elevated, although inventory is also incredibly low. But essentially, housing affordability right now is just awful. I can't imagine trying to be a new buyer in this market because not only have interest rates skyrocketed, but prices have not come down to reflect that reality. So like you, I would never make any prognostications about the future of the real estate market. But like you, I have a hard time seeing values staying consistent with where they are today.
Yeah, agreed. All right, we will leave that there. The next lesson, where do you want to go from here?
Well, another thing that investors learn the hard way is that inflation is not gone, right? We have seen the U.S. inflation rate reach over 8% at certain points throughout the year. And that is something that investors have not had to think about in literally 40 years. In the late 70s, early 80s, the inflation rate was very high in the US, but for the better part of 40 years now, it's been relatively tame. In fact, from 2010 to 2020 were some of the lowest inflation rates on record. And that lulled a lot of people, myself included, into thinking that inflation was a thing of the past. But I think 2022 proved that nope, inflation is not gone.
Yeah, and this will be interesting, certainly, to see how it impacts those of us in the financial independence community. Obviously, prices going up generally affect all of us, but I would like to bring Big Earn on from Early Retirement Now to see how this impacts safe withdrawal rates, because a lot of that is predicated on a certain return and a certain kind of standard, quote unquote. And we say that, Brian, we've used that, a normal inflation of 2 to 3%. Like I can picture myself saying that 30 times over the last 5 years in this podcast, but there's nothing, quote unquote, normal about that. And I think we've been, as you said, lulled into believing that that is normal, that that's permanent, and it will always be this way. We've tamed inflation. Well, I guess the last 12 plus months have proven we haven't tamed it. So all of these things we need to keep cognizant of and never kind of rest on our laurels that this is unchanging. We've won the war with inflation. Okay, we need to be aware of this. And how does it impact our plan and our path to FI? And, you just have to deal with the reality as you see it.
Yeah, I would love for you to have a Big Earn on to talk about his thoughts about inflation, if that does impact the safe withdrawal rate moving forward. But the bottom line for me is that I haven't ever had to think about inflation in any major way, right? Yes, we all pay gas prices and food prices, and those have gone up a little bit, but nothing like we've seen over the past 12 months. So inflation is something that investors have to think about and deal with essentially for the first time in 40 years.
All right, Brian. So the next lesson I think is maybe going to be a significant portion of our conversation here. This is a pretty important one.
Yeah, and the lesson there that I learned is be fearful when making money looks effortless. And if there's any time in my investing career that making money looked effortless, it was 2020 to 2021. So many people, it seemed like every day you'd go on Twitter and there'd be somebody there bragging about some massive return they got from crypto or NFTs or investing in stocks or using leverage or buying GameStop or AMC. And I personally vividly remember my portfolio hitting an all-time high in February of 2021. And it's been pretty much straight downhill since then. But I do remember at the time thinking to myself, there's something wrong here. Like there's no reason that my portfolio should be up this much in this short of a period of time. And my next action should have been to become more fearful and to trim and raise my cash position when making money felt effortless. And if there was any big warning sign that we should have taken, I vividly remember when that headline came out in, I think it was August of 2021, when somebody paid $1.3 million for a picture of a rock. It was an NFT that got minted, and someone literally paid $1 million for a picture of a rock. I mean, if that doesn't scream excess with the benefit of hindsight, I don't know what will.
Yeah, it's funny that you hit on that, because I think when we did those NFT episodes, Jonathan spent a lot of time harping on that in particular, which, that should be a blaring neon sign for anybody. This is insane. This is a bubble. This cannot be real. But yet, somebody paid that, right? Somebody paid millions of dollars for Jack Dorsey's first tweet, whatever the heck that means, right? Like, essentially, it's just a screenshot, right? It's so interesting. And I think what I've learned is nobody is immune to this, right? And FOMO is so powerful, that psychological concept of like seeing everybody around you getting rich quick, in essence, and quote unquote investing in this way. And it's hard. Like I was involved, and I've mentioned this on the podcast loosely in this NFT world, but knowing that it was, as I said on those podcast episodes, 99.9% of these things are going to go to zero. I had no reason to believe that they were worth anything in essence. But there were still times where I had something that went up on paper 10, 20, 30x, and I didn't sell the thing, right? So am I the idiot ultimately? I think yes in that scenario. Like I got caught up in the FOMO of it. And it's easy to say now, oh, that was stupid. Or beforehand say, oh, I could never get caught up in this kind of stuff, right? But the proof is in the pudding when it happens of, even though I knew this wasn't real, I still didn't sell it. So it's interesting when you see your own behavior, in essence, go against how you thought you would behave.
Warren Buffett has this great quote about investing. The intelligent investor should try to be greedy when others are fearful and fearful when others are greedy. And that's a wonderful quote that is so easy to say. But is it another thing when you're living through a period of extreme greed in real time, right? It can be easy to say, oh, this is crazy what's happening right now, right? Valuations are high. People that are brand new to investing are up 100%, right? People are in the crypto markets that are becoming millionaires overnight. That's one thing to see that from a small sliver of time. It's another to live through that day by day for weeks, months, and even years on end. That can do a lot to your psychology to make you think that we are in a new paradigm of time. And Morgan Housel had this great quote in 2021. This is when the GameStop thing was just going crazy and GameStop stock was just going parabolic, that I just love. And he said that the GameStop thing is a reminder that investing is not about the study of finance. It's the study of how people behave with money. And sometimes those behaviors are incredible.
Yeah, that's pretty profound. And I mean, he's spot on. It is amazing how much of it is this, you see this crowd stampeding and you get caught up in it. And luckily for me, in my case, and I'm being perfectly transparent here because I think it's really important. Like, this was not a large amount of money for me in the cosmic scheme of things, but so I looked at it as kind of fun, and this is silly, and who knows where it's going to go. But for many people, this was their life savings. They put their life savings into crypto, and many of these people lost sight because, frankly, a lot of them were younger, not as sophisticated. Just anecdotally, of course, I'm painting a broad brush here, right? But as you're saying, be fearful when making money looks effortless. And I think a lot of people got skewed to what a normal return might be. Mm-hmm. Right. And I think this might actually be like my biggest actionable takeaway is not to argue that getting more than a 10% return per year on an investment is impossible. I'm not stupid. I'm not arguing that it's impossible by any means. But I think kind of my mental heuristic, if you will, is if something is earning more than a 10% return per year, some type of alarm bell needs to go off in my head of, okay, what's going on here? Am I the sucker? Is this real? Is this too good to be true? Is this new? Is there any there? Which, Brian, we could talk about with FTX and crypto. I know you wanted to talk a little bit about crypto, right? But that 10%, and again, that's not to say that there aren't legitimate investors or investments that can earn more than 10% per year. But that is just the back of the envelope number that I now have in my head of like, okay, if it's over that, you got to start asking significant questions.
I remember somebody I followed online was new to investing in like 2019 or something like that. And they earned like a 100% return or something like that in 2020. And I listened to this person on a podcast, and they were talking about how they were essentially telling their investors that they plan on earning 20% per year moving forward, because if they earned 100% per year in 2020, earning 20% per year was easy by comparison, right? And I vividly remember listening to that, and I immediately tweeted, if you think earning 20% return each year is easy, you are about to learn a lesson the hard way.
Oh yeah, you're about to lose everything in essence. And yeah, so I think that's just kind of a good thing to keep in mind. And obviously, every single person can have their own number of what that is. And that's not to say, clearly, that if it's below a 10% return, that it's guaranteed safe, not arguing that at all. Because actually, Brian, we talked about this before we hit record. So BlockFi. So let's talk about crypto, because I think there's a lot going on there. It's the wild, wild west. And I think this is actually your next lesson, but it ties in perfectly to this be fearful when making money looks effortless. Is something like BlockFi, which seem to be, even though they have now declared bankruptcy, they seem to be a quote unquote good actor in this industry. And whether that's true or not is we'll ultimately find out. But they had a product that you could earn about 8%, more or less guaranteed return on your cash deposits. And your alarm bells went off with that, right? I don't want to put words in your mouth, but where is this return coming from?
Yeah, that was something I didn't understand, but I can tell you, I never opened an account with BlockFi or took them on as an advertiser or anything like that. But a part of me was like, 8% return from buying and holding crypto? That sounds good, right? But then I was like, I don't understand how they get that return. I don't understand where that's coming from. And if there was any industry that really took it on the chin in 2022, it was crypto. I mean, we saw a platform called Voyager went under, Celsius went under, FTX, which was maybe the biggest blow up since Enron, went under. And I think FTX going under also took down a BlockFi. To your point, we have no idea if they were good actors or bad actors or not. We do know that they declared bankruptcy, but 2022 was really the year that a lot of people learned, unfortunately, the hard way, that crypto is the unregulated Wild West, and crypto assets are extremely speculative, and you need to treat them as such.
Yeah, the Wild Wild West is, I would say, the perfect way to describe that, right? Because it all seems like a house of cards is how I'm looking at it now. And I have been loosely following the crypto world for the last, it's actually almost 2 years now. And I was really, really interested in it after being completely opposed to it for many, many years. And I still think Bitcoin itself is kind of silly because it doesn't seem to actually have, there's no like there personally, but that's a personal opinion. But I saw an entire economy built on the Ethereum blockchain. And in my mind, I'm looking for utility and value. That's kind of how I approach investing and investments. And oh, wow, it looks like there's an economy here. But this economy, quote unquote, was built entirely on these NFTs, which were kind of a joke at its heart. So I think I may have miscalculated as to, is there actual utility there? I don't know. The jury's still out. I think it's possible 5-10 years from now, we might find that the smart contract capability on that blockchain, like yada, yada, yada. This is not the time and place for that. But I think it's important to take a step back and say, okay, again, a lot of what people looked at as investing in this, and we use that term very loosely, Brian, was built on like this FTX company. They were, by all accounts, is what has come out. And again, we don't know. We're just following the news. But it seems as if this was a bunch of like 28-year-old kids with no accounting system, just taking money in, not keeping track of it, to the tune of $5, $10, $15 billion. They were headquartered in the Bahamas. It was truly the wild, wild west. And that money seems to have gone gone. And in the process, they are taking down this entire crypto to many players in the crypto industry because it's all this weird self-reinforcing circle of I invest in you, you invest in me, I come out with this new token, you come. It's ridiculous when you actually dive into it. But yet there were many millions of people, again, quote, investing in this. And we're finding out, oh, look, making money isn't quite as effortless as you thought it was.
And by the way, that also includes some of the most famous people in the world that tied up their brand identity with FTX, right? Tom Brady got wrapped up, became a sponsor for FTX. And I think him and Giselle had a decent amount of their own assets on FTX, right? Steph Curry was a sponsor. Larry David had a Super Bowl ad about FTX, which in hindsight actually looks quite hilarious, given that the whole ad was "Don't be like Larry," right? Are you in? I think Matt Damon was involved with this, so it's not like they had like D-level celebrities that were pumping them. These were very well-known people. I mean, there was the Miami Heat play an arena called FTX Arena, right? MLB associated with this, so there was a lot of social proof out there saying that FTX was one of the most legitimate players in crypto. And the fact that that turned out to be not true and that a complete rug pull, I think has severely damaged the crypto industry's reputation in society.
Yep, agreed. And yeah, so going along with this, when making money looks effortless. So we saw a bunch of different aspects of this, right? You kind of alluded to some of the Reddit, the Wall Street Bets type stocks, the GameStops, the AMCs, et cetera. Crypto, these NFTs, which on the face of it should have been obvious. Kathy Wood is another one with ARK that maybe we want to talk about.
Yeah. So Kathy Wood became a superstar asset manager in 2020. Her fund skyrocketed and she invested in a lot of growth stocks. She's a big believer in crypto, and she became the fund manager of the day. And she still remains very, very popular to this day. No, I have no clue if her strategy is going to pay off in the long term. And I would guess at today's prices that it will, but that's just a speculation on my part. But either way, she became very associated with a certain style of investing. She attracted a lot of assets, and many of her funds have performed absolutely horrifically for investors over the last year.
Yeah, and Brian, this actually reminds me of something you had told me a while ago about, I guess, a hot fund manager does not equal high returns, in the sense that, okay, there might even be a hot fund manager a la Kathy Wood who's getting X percent returns. And this was in the good years. But that doesn't mean her investors were getting that return. I think this is a really critical thing to dive into.
Yeah. So my favorite recent stat from that was in the 2000s, which were essentially from 2000 to 2010 was essentially a lost decade for investors. The markets had two big bear markets and went sideways, and the investing returns from the S&P 500 were essentially rounded to zero for a period of 10 years. But during that time period, the hottest mutual fund from 2010 was called CGM Focus Fund, CGMFX. During 2000 and 2010, that fund returned 18% annualized during the lost decade for a period, which is obscenely good, just incredible outperformance. But the most interesting stat about that return period from 2000 to 2010, while the fund returned 18% annualized, the typical CGMF-focused investor had a return of negative 11% per year. And if you're like, how could that possibly be? How could this fund go up 18% annualized and the average investor in the fund lost 11% per year? And the answer there is behavior. Their behavior was exactly wrong. When is the time that investors plowed money into CGMFX? Answer is after a big run-up, after it was topping the mutual fund rankings as best fund of the decade and all that kind of stuff. That's when money pours in to these funds. And then immediately after getting a huge dose of money, that's when the fund had some volatility on the downside. And what did investors do after this amazing hot fund had a negative return? They pulled money out. Right? So even if an investment does well, if your behavior around that investment is wrong, you yourself will do poorly. And I believe this same phenomenon actually happened to Peter Lynch's investors from 1978 to 1990. His fund returned some crazy number, over 20% per year. But I think the typical fund investor in his amazing legendary fund only returned like 7% per year. So just way less than the fund delivered, simply because they were buying after a good period and selling after a bad period.
Yeah, it is astonishing. And it goes back to that psychology. That really is a through line for all of this, for all of investing, right? And it's hard not to get caught up in it. But I think the more that we drill down into these lessons, the more that people can really try to understand it and synthesize that information and know, okay, the next time this happens, you might have gotten caught up in it, right? You might have bought some of the ARK funds, and that's fine. You know, obviously we'll see what happens. But the next time there's a hot investor, the next time there's a hot fund, okay, maybe it helps you gird against that FOMO, because that's what it comes down to. It's FOMO.
It's so easy to tell yourself that you're going to do the right thing in theory, but it is an entirely another thing when you're actually living through a period of excess greed or excess fear to actually act counter to how your lizard brain wants to act, right? All these lessons are really important and easy to understand in theory. Putting them into practice is just very hard.
Yeah, agreed. All right. The next one, I think for a long time we've heard cash is trash. Is that true, Brian?
Yeah, a lot of big famous investors have been saying cash is trash for years. The one that comes to mind is Ray Dalio, the hedge fund manager of Bridgewater. I think it's the largest fund in the world. He has been making macro calls, and I believe that actually his macro calls for 2021 have been largely correct. I think that his fund, I think his fund is up in a period when the entire, when despite all the chaos of 2022, Bridgewater, I think, has performed very well. But people like him and Robert Kiyosaki have been saying cash is trash for years. And I think that that's wrong. 2022 taught us that nope, cash isn't necessarily trash. Even with inflation kind of raging, yes, cash loses value over time, right? Inflation eats away at the value of that cash, but it's still an integral part of any investor's portfolio. And to me, the real return you get on holding cash isn't the interest rate you get from holding that cash. Rather, it's the peace of mind that you get as an investor, knowing that that cash is there and safe. And moreover, the future optionality that that cash provides to allow you to buy assets when everybody hates them.
Yeah, that optionality is critical. And I think of Mr. Buffett sitting there with somewhere on the order of $100 billion in Berkshire Hathaway, and he has options galore. And regardless of whether he pulls the trigger or in what capacity he pulls the trigger, having those options is fantastic. And I know he used that to great effect in the great financial crisis of 2008, 2009.
Yeah. That's a great example right there. I mean, $100 billion that he kept in cash, just sitting there, earning next to nothing. And this is like the greatest investor of all time. And he actually, one of his shareholder letters said, I think they try and keep 20 billion in cash at all times, just for like to handle the insurance liabilities and all that kind of stuff. But he's essentially well above that number. And one of his recent shareholder letters said, we understand that we have $100 billion in cash. We don't like having this much cash, but we think that this cash will show its value in the future, when something bad eventually happens. So the return that you get on cash isn't measured in the interest rate. It's measured in the future optionality and uses of that cash.
Agreed. Totally agreed. All right, Brian, what's the next lesson?
I would say that bonds, for the first time ever in my investing career, are finally worth considering. I've been investing for almost 20 years, and essentially over the entirety of that time, bonds have had zero appeal to me, just zero appeal, because they've paid effectively 0 or 1% interest rate. And I personally am comfortable with lots of volatility, so I didn't need the ballast that bonds provided in my portfolio. And a lot of investors have felt the same way. However, now that interest rates are finally reverting back to actually normalized level, bonds, I think, are worth considering for the first time ever. And I believe it was last year, you had a wonderful episode on Choose FI that really dug deep into the thinking about bonds. I think it was with Frank.
Oh, yeah. That was episode 194, actually, with Frank Vasquez from Risk Parity Radio podcast, which is fantastic, by the way. And it was the role of bonds in a portfolio.
Yep. And even though bonds have had a terrible year, 2022 has been a terrible year for bonds with interest rates rising, the bond prices are falling. I do think for the first time ever, they're actually worth considering, even if you have a very long-term time horizon like I do, because the interest rate that you could be earning from your bonds are actually enough to entice me to put a portion of my portfolio into them.
That's interesting. So, okay, tell me more about that. So, are we talking about newly issued bonds with more significant interest rates? Because in a couple sentences, you're saying, yes, I understand. And I'm saying bonds had a terrible year in 2022, but yet you're still considering bonds as a portion of your investment. I'm sure somebody out there is listening and saying, I don't exactly understand that. Could you tell me more, Brian?
Well, yeah. So the one reason I was avoiding bonds was because with interest rates so low for so long, I felt that there was only one way that interest rates could eventually go, which is up. And interest rates rising is really bad news for existing bonds, because as interest rates rise, the value of current bonds does fall. Now, I don't claim to be an expert at bonds at all. It's something I've never had to really think about as an investor. So if I was to invest in bonds and make them part of my portfolio, I'd probably do so just with index funds, right? Buy the total bond index fund and add that to my portfolio. But it's just that for the first time ever, I'm actually considering doing that because yields are starting to get enticing enough for me to keep some of my assets in bonds versus my huge exposure to equities.
Yeah, no, that makes sense. And the only bond exposure that I personally have is with the government I bonds, but that's not a significant amount. And that's slightly different than what you're talking about here with maybe a fund, just as an example, of course, not financial advice, but like BND would be the ticker symbol, right, for the Vanguard Total Bond Market Fund. So that's something, again, everybody has to do their own homework and figure out what their investing strategy looks like. But you're saying for the first time in your investing career, you're actually strongly considering that. So I suspect many people are going to start looking into that at the very least.
Mm-hmm. They're finally a potential viable alternative to stocks.
Nice. All right, Brian, next lesson. What do we got?
How about owning growth stocks is harder than you can imagine. So growth stocks have been a fantastic place to be for the last 10 plus years, essentially in the wake of the great financial crisis. We've seen the markets really reward companies that had really high growth rates. What we've seen over the last 2 or 3 years is a tremendous amount of companies that were growth companies came public either via IPO, initial public offering, or via SPAC, Special Purpose Acquisition Corporation. And if you look at the returns of a huge number of those recent IPOs or growth stocks, they have been absolutely brutal investments to make over the last year. I mean, no joke, some of these stocks, these high-flying growth stocks, many of which I own, by the way, are literally down 70%, 80%, or more.
Wow. Yeah, that's remarkable. And like you said earlier, the discount rate was actually a significant portion of this. So you did allude to this earlier in passing, but I wanted to ask, I know you've talked about like your investment thesis before and how you consider when you make purchases and when you reconsider on the selling side, et cetera, because obviously, as you're well documented, you have a lot of, or individual stocks is a significant aspect and percentage of your overall net worth. How do you consider something like this? As you said, okay, the Federal Reserve, you didn't understand the importance of it. And okay, things have changed that maybe might not have even been on your investment thesis. I'm putting words in your mouth. It very well might have been. But okay, this is a new factor I need to consider. How does this change my overall investment thesis for many of these high-flying growth companies that I am invested in and I understand are cyclical and of course, things go down 50%, things come up. But what if there's something brand new that you hadn't considered before?
Yeah, and to be clear, I've always known that interest rates do impact these things. I think I just underappreciated how much interest rates have impacted them. So yes, to your point, I'm a person that likes to invest in individual companies. I like to do the research on them. I like to take them through an investing framework, and I like to make them a part of my portfolio. However, one thing that I've done to protect myself is I know going in what the risk level of many of these companies are. Either the business could face some risk, perhaps it's unprofitable. Perhaps it needs a strong stock price. Perhaps it's going to be selling equity into the future. I'm very cognizant of those business risks going in. At the same time, I also pay attention to valuation risk. You can have a great company growing very fast, but if you pay a nosebleed valuation for it, it can take a long time to make money on that company because there's huge valuation compression. I've known that this whole time, and the way that I've protected myself from those two risks is with allocation. I put a smaller allocation to companies that have higher risk portfolios going in, and I put a bigger allocation to companies that I deem to be lower risk going in. But having said that, it's easy to, a lot of people have been interested in investing in growth companies over the last 3 years, 5 years, 10 years, myself included. And the key point to me is that owning growth stocks is just much harder than anybody can imagine. I can look back at the dot-com bomb, right, when we saw companies like Amazon and Priceline literally lose 90% of their value and just say, oh, that looks painful, right? That looks really, really hard. However, many of those companies came back. But living through one of those experiences day by day and seeing the returns that some of these companies have had experienced for their investors, living through that is just so much harder than most people can imagine.
Yeah. Brian, how would you define for a listener out there growth stock? So they've heard the term, certainly you hear growth and value, but in this day and age, what exactly does it mean to you?
Yeah, so Buffett has pointed out that there's really no difference between growth stocks and value stocks. They are the same thing. In fact, you can't value a stock without making some assumptions about the company's future growth rate. But I loosely define that as a company that investors are expecting to grow its top line by 20% or more for their foreseeable future. And that is a significant portion of where the current value of the company resides. So I consider a quote unquote growth stock to be any company that investors are banking on growing its top line very rapidly over the next couple of years for that investment to make sense today.
Okay, gotcha. So 20% top line. Would you say, like by definition, the PE ratio would be higher on these since investors are forecasting future growth based on current valuation is built in for this rosy scenario in the future?
If the company has a PE ratio at all, because to have a PE
Right.
ratio, you have to have earnings. And many of the companies that are growing the fastest do not have earnings by design. So therefore, they don't have a PE ratio by design. But to your point, yes, many of the companies that have the highest growth rate, if they do have a PE ratio, it's very common for that PE ratio to be very high, much higher than the broad S&P 500, for example.
Hmm. Yeah, it's interesting because, we kind of like derisively look at Wall Street bets and talk about them as meme stocks. And for good reason, obviously, a lot of those were ridiculous. But really, to a large degree, you could make an argument that these quote unquote growth stocks, they're built on a meme, they're built on a story. The meme might be the wrong term, but they're built on a story of what's going to happen in the future. And that future is unknown, just like every future is unknown. It is interesting, right? When you look at this list of growth stocks, these are companies that many of them are names that we've heard of, but yet, okay, their financial results today might not back up, I guess, the overall market cap of the company. And we're looking at what is the story for the future. So I'm not making value judgment, good, bad, or indifferent. It's just, okay, you have to understand what you're doing when you're buying a company like this and what the valuation is. It's based on a future that may not come to pass, just like every future may or may not come to pass.
Yeah. And many of the companies that are down huge aren't like small cap, unknown businesses. Many of these companies that are down big have brand names and are products and services that a large portion of the audience have heard of or even used, like Peloton, for example, DocuSign, Snapchat, Coinbase, Square, Cloudflare, Lyft, Zoom, Zillow, Spotify, right? These are not unknown names that nobody has ever heard of. And yet these companies in each of those cases are down at least 70% from their 52-week high, if not more. So if you're going to be investing in growth companies, which by the way, I am and I still do, you just have to be able to withstand huge amounts of volatility. And I have a feeling it's more volatility than you think.
Yeah, agreed. And yeah, I think one of your next lessons is narrative follows price. And I think that can tie into this prior lesson, but I'd love to hear the nuance of this one.
Yeah, this is something that's so funny. People think that price follows narrative, but it's actually narrative follows price. And many of those companies that I just talked about, Peloton in particular, Peloton was like a darling of the investment world in 2020, right? Their growth rate was insane. They were adding on new customers. Customers were sticking around and using their product multiple times each month. The business was profitable. It was expanding. The brand name was well known. And that stock is currently down more than 90% from its 52-week high. And you think about the narrative have just changed so completely on a company like Peloton simply because of its price, right? In 2020, when the stock was a multi-bagger from its IPO, the narrative was Peloton, it's the gym killer, right? It's here to stay. And now that the stock is down 90%, they're like, this company is trash. It's going bankrupt. People only use their Pelotons as clothing hangers, essentially. So it's so interesting on Wall Street how you think that price follows narrative. In fact, the narrative follows the price.
Yeah, and I wonder how business fundamentals ultimately tie into the reality of this narrative, this meme, as I kind of am jokingly calling it. Like, it's what is the future? Okay, but sometimes the reality of today smacks that future in the face, right? And it's when you look at a company like Peloton, and granted, I haven't jumped into their financials all that significantly, but it seems as if this was a money-losing enterprise for as far as the eye could see. And I wonder how the narrative following the price versus the price following the narrative ties into ultimately the reality of how is this company run? Is growth for the sake of growth? And we talked about this last time you're on, or maybe 2 times ago you're on the podcast. And I asked you, can a company in essence just focus on growth and lose money? At some point they have to start making money, right? And you responded with the one perfect example of Amazon, right? Which still sticks in my craw a little bit, that like, okay, yes, that is the one perfect example. But in essence, for the vast majority of companies, they can't run losses in perpetuity. At some point, investors are not going to keep just piling money in for them to incinerate it in a fireplace, right? So like, as an accountant, and maybe this is my bias as an accountant, maybe I'm naive, Brian, honestly, like when it comes to the market, that maybe this can last for much longer for many more companies than I would give it credit for. But it is I'm kind of weaving a tale here, but it's interesting how this all just ties together reality and narrative.
Yeah, Amazon is in many ways such an outlier that it's hard. Maybe perhaps you should just throw it out altogether because it has broken so many rules from a business and stock and return perspective, and it's worked out spectacularly well. But yes, to your point, over a long enough periods of time, companies do have to generate a profit from their operations if they hope to do well. Although sometimes it can take a long time for those profits to appear. And then once they appear, boy, do they appear. I mean, another kind of outlier investment in many ways has been Tesla. Tesla came public in, I think, 2010 and lost money all the way up until essentially 2020. Now the company is minting cash at a huge rates and it's free cash flow positive, highly, highly profitable. But that is a company that did have to eventually start generating a profit for investors to truly appreciate its stock. So yeah, you can lose money for probably longer than you think that you should in the public markets, but in the long term, a company's valuation and the stock price follows what the fundamentals of the business do.
Right. And yeah, Tesla is an interesting one. And we could probably spend an hour talking about Tesla. But yeah, it's fascinating, right? That as you said before, when I was talking about PE ratios, and sometimes they're not calculable because there's negative earnings, right? But as you're saying, Tesla now has significant earnings, but at least as I understand it, the market cap of Tesla, even after getting cut significantly, is still more than essentially all of the other automakers in the world combined. That's the roughly, it might be slightly off when we're recording this, but relatively close, right? And like that is still built on a narrative, even for a company that has earnings now. This company is an investable company because of its earnings. I mean, by any definition, take the story, the narrative out. But is it worth more than all of the other automakers in the world put together when all of those other automakers are all of a sudden spending a lot of their time and talent and resources in electric vehicles, right? It's interesting. And I'd love to hear, because you are a longtime Tesla shareholder. Like, how do you think about that?
Yeah, so I might not be the best person to ask about that because Tesla is my personal number one holding. It's my biggest winner of all time. And I own and drive a Model Y. So I am very much in the Tesla bull fanboy camp. But let's just say it's my number one position and I have no desire to sell anytime soon.
Interesting. So, and it's funny because my alarm bells go off when we're talking about these lessons, right? Like, you know, the fanboy thing. And I know you're kind of jokingly saying that, but that's what a lot of these things that I saw of the craziness over the last year or two was people becoming fanboys of X, Y, and Z person. And like, it's almost as if it's this human tribal nature that we seem to have of like, oh, I'm a Bitcoin person, I'm going to put the laser eyes on, or, oh, I love Chamath. So SPACs, which are ridiculous on the face of them, and companies that would have no business in most cases IPOing, but because they're SPACs, they're great. Like, it's all of these silly things. And I think that's where we as humans like get into dangerous territory when we start like becoming members of tribes as opposed to, okay, does this make sense for me? So anyway, that's a total sidebar. You're obviously super intelligent and you know what you're doing. I'm not trying to give you investing advice here, but it is an important thing for all of us to remember.
Yep. And we'll see if that works out for me. But my money is where my mouth is on that one.
Yep. Indeed. All right, Brian, we're up to the last lesson here. What is it?
Yeah, I think it's a very important one. And that is your actual risk level cannot be computed ahead of time, especially during bull markets. It can only be revealed to you during a bear market, right? It's very easy when you're picking an investment strategy for yourself. For if you're working with a financial advisor, they sit down and say, okay, how big of a loss can you take in theory, right? Is it 10%? Is it 20%? Is it 30%? And they build an investing strategy based around that. But the idea of experiencing a 30% loss in theory and actually seeing your portfolio fall 30%, 40%, or even more, as we've seen over the last year, in reality, those are just two different things. And one good thing about bear markets, good things in air quotes, is it actually reveals what your true risk level is. And I firmly believe that your risk level can't be known ahead of time. It can only be discovered as you live through a bear market.
Yeah, I like that. And I think for many of us, we've maybe had a couple opportunities over the last 36 months of seeing potential significant drops. It's hard to remember at this point the March and April drop of 2020, right? Because obviously asset prices went up significantly after that. But for many of us, that was maybe the first time that we had seen this massive drop. And now we're seeing maybe a more extended drop in 2022, as you were saying, the whole reason we're doing this episode. And right, so that's two of these lessons, that these experiences that we've lived through. And as you're saying, you can't compute that. It's easy to say it on paper, like, oh, you take this investment questionnaire, like, how aggressive or conservative are you? Yeah, it's easy to say I'm aggressive or I'm going to invest when the market goes down, but it's revealed when that actually happens. So that is a brilliant, brilliant final point, Brian. Thank you.
10 or 20 years from now, assuming humanity continues to thrive, assuming markets recover and go back up. And by the way, if they don't, our investment returns will be the least of our worries at that point, right? It's going to be very easy for new investors 20 years from now to be like, wow, 2022 looks like a great buying opportunity, right? Great time to buy bonds, great time to buy stocks, great time to buy all these things. But that's looking backwards at what happened and then asking yourself today, what's the experience been like of living through the last year and a half, 2 years, right? We've dealt with geopolitical tensions that we haven't seen in years, right? What's it like to invest when Russia invades Ukraine and there's talks of nuclear war being threatened? What's it like to actually invest when interest rates are rising like crazy and even the bond portion of people's portfolios have taken a beating? What's it like to invest when you see tech layoffs starting and there are calls for being a recession in 2023? Right? What's the actual experience like to hold assets during periods of market turmoil? It's very easy to look backwards at past declines and say, obvious buying opportunity. It is just an entirely different thing to actually live through them in real time.
Wholeheartedly agreed. Wholeheartedly agreed. Brian, thank you so much for coming on the show. Happy New Year to you and to the audience. And as always, where can people find you?
Sure. The best place to find me is on Twitter. I'm at Brian Feroldi. Happy New Year to you. And I'm, for one, hoping that 2023 proves to be a more profitable year for all investors.
So, Brian, obviously we said 2022 was a big year for you with publishing a book. Maybe a slightly wrong title in hindsight, but what does 2023 have in store for you?
So the big thing for me is I'm running a course that teaches people how to find, read, and interpret financial statements. It's a 3-week boot camp. If that interests any of the Choose FI listeners, we have a discount code that is available. So you can find the link right on my Twitter. So I'm at Brian Feroldi, and I think we're also going to put one in the podcast notes.
Okay, that's very easy. And yeah, we have talked about that in the past, and I think it's critically important. You came on and we did an entire episode on the 3 main financial statements that we all need to understand just as investors, but as business owners, right? As people who are interested in personal finance, because it's so important. And I can say this as an accountant who didn't love his career in taxation, but the fundamentals of accounting have helped me dramatically. And I think it's really important that people just get that understanding because it impacts every aspect of business and finance.
Totally agree. In fact, again, I think that learning the language of business is important, even if you never analyze a business or buy a stock or anything like that. I just think it's a skill, a business skill that few people have. And if they develop the time to do so, they can really enhance their personal career.
Awesome. All right. So you're at Brian Feroldi on Twitter, and I'm sure we will have you on the podcast in the very near future. As always, Brian, thanks for being here.
Thanks for having me, Brad.
And to the audience, thank you so much for listening. Happy New Year. And this is going to be a great year of content here at Choose FI. I appreciate you being here.